Brad Williams, Frugal Finance, Beginner's Guide to Stocks. The overview. Essentials. Stocks are also referred to as equities because they represent an ownership stake in the company. Stocks and stock funds, such as mutual funds and exchange-traded funds, can be an important component of your portfolio. New investors may want to consider stock funds rather than individual stock picking as a way to cost-effectively diversify their stock investment. While stocks have historically outperformed bonds over the long term, stock prices fluctuate and can go down, sometimes quite dramatically. Investing in stocks to meet a short-term financial goal can be risky because of stock price volatility. When you invest in stocks, you buy ownership shares in a company, also known as equity shares. Your return on investment, or what you get back in relation to what you put in, depends on the success or failure of that company. If the company does well and makes money from the products or services it sells, its stock price is likely to reflect that success. There are two main ways to make money with stocks. Dividends. When companies are profitable, they can choose to distribute some of their earnings to shareholders by paying a dividend. You can either take the dividend in cash or reinvest them to purchase more shares in the company. Investors seeking predictable income may turn to stocks that pay dividends. Stocks that pay a higher than average dividend are called income stocks. Capital gains. Stocks are bought and sold constantly throughout each trading day, and their prices change all the time. When the price of a stock increases enough to recoup any trading fees, you can sell your shares at a profit. These profits are known as capital gains. In contrast, if you sell your stock for a lower price than you paid to buy it, you'll incur a capital loss. In either case, your fate as an investor depends on the fortunes of the company. A company generally needs strong earnings to pay a dividend, and there needs to be investor demand for you to see capital gains. Stock performance. Investor demand typically reflects the prospects for the company's future performance. Strong demand, the result of many investors wanting to buy a particular stock, tends to result in an increase in stock share price. On the other hand, if the company isn't profitable, or if investors are selling rather than buying its stock, your shares may be worth less than you paid for them. The performance of an individual stock is also affected by what's happening in the stock market in general, which is in turn affected by the economy as a whole. For example, if interest rates go up, some investors might sell off stock and use that money to buy bonds. If many investors feel the same way, the stock market as a whole is likely to drop in value, which in turn may affect the value of the investments you hold. Other factors influence market performance, such as political uncertainty at home or abroad, energy or weather problems, or soaring corporate profits. However, and this is an important element of investing, at a certain point, stock prices will be low enough to attract investors again. If you and others begin to buy, stock prices will tend to rise, offering the potential to make a profit and to reverse any paper losses those who stayed in the market experienced during the dip. That expectation may breathe new life in the stock market as more people invest. This cyclical pattern, specifically the pattern of strength and weakness in the stock market overall, or a majority of stocks that trade in the stock market, reoccurs continually, though the schedule isn't predictable. If you have any questions as it relates to buying or owning stocks, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helped. See you soon.